Imagine walking into a bustling mall in Beijing, a city that never seems to sleep. A delivery driver scans an address, a BYD electric vehicle hums silently past, and shoppers are weighing their next purchase, a new rice cooker, perhaps. Beneath the surface of this scene lies a calculated push by the Chinese government to rekindle consumer spending. It's a strategy that blends optimism with complexity as policymakers widen trade in subsidies to reinvigorate a sluggish economy. But as with every ambitious policy, this story has more layers than meet the eye. Let me take you through the intricacies of this subsidy program and the questions it raises about its effectiveness, sustainability, and long term consequences. The push for consumption. China's expanded subsidy program seems, at first glance, like a win win. Discounts for everything from smartphones to air conditioners aim to spark a buying frenzy, up to 20% off sales prices. A generous government foots the bill. Renewable energy vehicles come with subsidies as high as 20,000 yuan, a bold nudge toward greener living. Policymakers hope this will cushion the blows of declining exports and rising US tariffs. After all, domestic consumption has been slow, and stimulus seems the logical fix. But dig deeper, and cracks begin to show. Crowding out effect, a skeptical market. The theory behind subsidies is simple: increase affordability and drive demand. Yet, critics worry about the crowding out effect. When governments pump funds into specific sectors, private investment often hesitates, leaving an imbalance. Stock markets, in their infinite skepticism, have mirrored this concern. Indexes like CSI 300 and Shanghai Composite dipped after the announcement. The message? A subsidy program might be a temporary boost, but does little to inspire confidence in structural recovery. Diminishing returns. Been there, done that. This isn't Beijing's first dance with subsidies. A similar trade-in program last year spurred sales of millions of renewable energy cars and home appliances. The results were encouraging at first, but as the law of diminishing marginal returns suggests, each new subsidy round delivers less bang for its buck. People can only replace so many microwaves and rice cookers before demand fizzles. In fact, some consumers might already feel saturated from last year's spree, questioning how much more these incentives can realistically achieve a ballooning budget deficit. Then there's the elephant in the room: funding. This program is not free. The issuance of special treasury bonds, like the 81 billion yuan already allocated, adds strain to an already stretched budget. With a growing fiscal deficit and local governments strapped for cash, the bill will eventually land on someone's desk. Future generations might inherit this debt, or local authorities might cut spending on vital services like healthcare and education. Either way, there's a price to pay, one that extends beyond shiny new rice cookers, the wealth effect, and a generation in retreat. Another challenge lies in the very psyche of the Chinese consumer. Declining property values and uncertain job prospects have dulled the wealth effect, where people spend more when they feel wealthier. Add to this a cultural shift among younger generations who increasingly opt for a more laid back lifestyle. Why hustle hard when institutional support feels fragile and economic headwinds seem endless? Policymakers can roll out subsidies, but without restoring confidence and ambition, the program may fall flat. The institutional quandary. Finally, let's consider the institutional landscape. Local governments, burdened by debt and eroded revenue from land sales, struggle to meet even existing obligations. Beijing's central government must step in, but this risks over centralization and inefficiencies. Long term, robust institutions, not quick fixes, are what China needs to weather its economic storms. China's expanded subsidy program is a bold move, crafted with urgency and precision. It represents hope in an era of economic uncertainty, a plan to reinvigorate consumer spending and cushion external shocks. But, as with all such policies, there's a delicate balance to maintain. The questions of sustainability, diminishing returns, and generational impact loom large. Ultimately, the success of this initiative won't hinge solely on subsidies. It will depend on whether Beijing can instill lasting confidence and resilience in its people and institutions. Otherwise, today's subsidies may pave the way for tomorrow's debt.